many of the factors that are important in any real estate valuation, but what makes evaluating a DST unique is the legal and financial structure that makes it a prepackaged investment. This is what we call structural risk. This relates to the financial structure of the investment, not the structure of the actual building. It provides rights to the involved parties, which includes investors, the sponsor, and lender, and dictates how each will be compensated. These terms are laid out in the Private Placement Memorandum, otherwise known as the PPM. There are three main components we review as part of the overall analysis of structural risk. The first is upfront fees. This is comprised of selling commissions and additional costs in the total offering amount to investors. This is a key metric to understanding your own economics going into a DST. The premium is essentially the amount above market value of the property investors are paying to invest in the DST. We then take these figures and compare the fee structure to market averages. Next is sponsor compensation. How much and in what form is the sponsor getting compensated? For this component, we like to look into whether the sponsor is receiving a disproportionate amount of the cash flow relative to the amount of risk they are taking on. There are several ways to determine if the sponsor is incentivized to maximize investor returns. For example, if a sponsor receives a large amount of compensation upfront and at exit, but little during the hold period, this indicates they are incentivized to shorten the hold period to get paid earlier, which may not be in the best interest of investors. Third is the master lease. The master lease has the largest impact on DST investors' annual returns out of these three items. For each offering, the sponsor puts together a 10-year projected cash flow statement for the investment that includes projected investor returns. If the property's actual performance varies from the projected performance, that's when you see the impact of the master lease. In the case of overperformance, how does it benefit investors? If the property underperforms, what impact does that have? Sponsors will have different financial structures, which will have varying impacts on investor distributions. If distributions are capped, for example, the property overperforming projections will not yield any higher yield to investors. Distributions can also be made out of principal rather than through operations, which is most common in unstabilized assets. Something we really like to look into for our clients is sponsor-investor alignment, and each of these three play a factor in determining sponsor-investor alignment.